what we're going to talk about today is there have been 2 new volatility ETPs that have gained approval. So they've passed regulators and they have actually officially been approved now. That doesn't mean that they've launched yet. They are not actively trading. And to be honest, it doesn't mean that they will ever launch. It's certainly possible that they would be put on hold for a while and then things might change and they may not ever actually get launched. But it is a very good sign that they were listed, filings were made over a year ago, and we've all been kind of patiently waiting in the volatility space. We're aware that they're out there. I actually did a video. I'll just show you that real quick. I actually did a video over a year ago. If you go to the YouTube channel, there's a little search function. You can go right here and just type in SVIX, SVIX. And I actually did a video on this product that we're going to be talking about today over a year ago. So this has actually been a fairly long process for them, this group that's trying to get it together. And now it's, I guess, to the secondary stage where it has actually been approved. So good time to talk about it today. Certainly doesn't mean that it's going to launch. I hope they do, but we'll see. And when they do, of course, I will do more videos. We'll probably do a follow-up live stream when that happens. There will be lots to discuss. And once they do launch, then we can start talking about how to use them in strategies and whatnot, the risk factors and all that. But let's just do a casual chat today. I'm going to show you a few charts, and we'll just get an idea of where these 2 fit in. So the first thing that we are going to look at is our current volatility landscape. This is essentially, there are other volatility ETPs out there. There used to be dozens, but these days there are several others as well. But these are sort of the general, covers every section of the VIX futures curve. And these are the main ones that tend to get the most volume. And really, if you wanted to just cut right through everything, the only ones that you should be focusing on. Sure, you can trade some of the others if you happen to like them, but you can't go wrong just focusing on these. Everything in color is something that is currently live. And of course, this top section across the top, these are things that we used to have. So anybody who's been trading volatility for a while, you will of course be familiar with all of these tickers, even though a few of them are unfortunately gone now. What I will say is I am very welcoming of one of these products to get launched. I'm very excited about it. I'm hopeful that it does pass. And then there's another one on this list that, to be honest, it could just die and never come back, and I wouldn't care at all. So maybe we'll start with the one that I don't like, and that is, if you know me, on this side. So the TVIX, right? This old 2 times leverage factor TVIX. You can see it there. So maybe what I should do is just briefly, for people who are rather new to this spectrum that you're looking at, if we start over here on the left, all of these ETPs are essentially tracking the rolling values of the VIX futures contracts. So I'm sure you've heard of this before, but if you go to the good old VIX Central, everybody's favorite website, these are the VIX futures right here. And the front 2 months here, these days anyway, these are the ones that you want to focus on. So all of those volatility ETPs are just tracking only the changing values of these front 2 futures. Now, there is one of them that goes into the midterm futures. Talk about that in a second. But what we are essentially looking at is across the board, on the inverse side of things, the old XIV. All right, this was a product that I'm sure you've heard about. It launched in 2010. It was basically the original inverse volatility product. Had a lot of success, a lot of people trading it over the years. And then, as we'll get into later, I'll actually show you what happened to it. Unfortunately, it met a fairly untimely demise. But that's the 1 times inverse, and it is gone now, right? We haven't had one of these in over 3 years. The next one, SVXY, this is a product that exists now. You can trade it, and it is a minus 0.5 times daily inverse. So what that means is you can buy this product on the long side, but it is essentially an inverse volatility position. It's a short vol position, but you're buying the shares on the long side. So that's why these products over here, they're actually somewhat useful, because you don't have to go out and short the ETPs directly. You can actually buy them on the long side and still represent a short vol position. So that's why they're so popular. The next one over here, this one hurts me a little bit to even talk about because it was, as I've mentioned many times, my favorite volatility ETP. And unfortunately, it is also now delisted. This one differs a little bit from the old XIV in the sense that it's actually, let's get rid of that. The old XIV was actually focusing, instead of these front two, it was focusing on the 4, 5, 6, and 7, which has a lot of unique benefits to it. It moves a little bit different. The risk reward profile was always different. So it was actually my favorite product. Very unfortunate that we lost it last year. But that on the inverse side is the spectrum there. And then if we go over to the long vol side, VIXM, and there's also one called VXZ that's still around and doing okay, I guess. Low volume on both of these, but these are good as well. So you might want to give them a look. These are the same thing as the inverse ZIV was, except on the long side. So it's long volatility, M4 to M7. And I like this product. It's not very well known. The volume's pretty low, but it really does behave quite well in market crashes. And maybe I'll do a full video at some point on the benefits of using VIXM over something like the next one, VXX, which is the longest running volatility product, the originator of it all, launching in January 2009, the VXX, 1 times long volatility. So essentially tracking with 1 times leverage, the daily changing values of a combination of these front 2-month VIX futures. That's what the VXX is. And in my opinion, of course, you can get everything done that you need to get done in the volatility space, both long and short, and everything in between, using just VXX and its options. So if you were to focus on just one of these, that's probably the one. For me personally, I do love the ZIV, but the VXX, you can't go wrong with just defaulting to that for everything you do in the vol space. Then, of course, now we're getting into the leverage factors, UVXY. This is a popular product, so of course I talk about it a lot, but to be honest, now we're getting into the range where you might want to just start ignoring these because the risk factor is increased, and I'll get into why that's important in a minute. But the UVXY is a 1.5 times daily representation of the underlying VXX. So leveraged, it actually used to be 2 times, but in 2018, a little over 3 years ago, they deleveraged it to 1.5 times. Little more manageable, but still outside of my risk tolerance personally. So I don't use UVXY very often. Maybe just for put verticals, call verticals, defined risk spreads. I still sometimes go to the UVXY options market, but I certainly don't buy it long or anything like that. And I don't short the shares. And so, of course, it goes without saying that the old TVIX being even more leveraged than UVXY, I'm even more against it for reasons that we will get into now. So the main problem with the TVIX, and the reason I say that one of these products I am very welcoming of getting launched, and the other one, honestly, I'm personally just going to ignore it even exists, outside of education. Of course, I'll always be there to tell you why these are terrible ideas. But this TVIX, let's show a chart of what it looks like. You might get an idea of why this thing is fairly difficult to control in a trading environment. So this is the 2 times leverage factor TVIX from its inception in November 2010 all the way to the delisting in July of 2020. Now, obviously, this is a pretty diabolical decay factor here. It went from 2.5 billion, that's on a split adjusted price. It didn't actually ever show a price of 2.5 billion. But if you go backwards and adjust for all the reverse splits along the way, it's gone from 2.5 billion to $112, down 99.99%. So the problem here should be fairly obvious that if you're going to be buying this on the long side, you are buying something that has such an extreme decay factor that presumably you're doing it because you think you can time a volatility spike. Even if you get it right, and even if a volatility spike does happen, the devil's in the details and the timing here, and you could bleed an enormous amount of capital waiting for that volatility spike to happen. Happens all the time that people buy TVIX, they wait around, they think the market's going to crash. By the time it eventually does crash, they've long had to close out their position because it just bleeds too quickly. This is something that is very, very difficult to control. Timing volatility spikes in itself is nearly futile, but trying to time it with a 2 times leverage factor ETF is just a really bad idea. So some people might be thinking, well, great, then why don't we just short it? Why don't we be the smart ones that are going to make the money on the other side of the trade? Clearly, this thing goes down all the time, so let's short it. The problem there is those little spikes, while they may not look like much, when this thing does spike up on a volatility spike, it can be extremely violent. And unfortunately, doesn't matter how good your trading strategy is, how good your metrics are, you will get caught with those volatility spikes from time to time. Of course, as risk managers, we want to reduce it as much as possible, but you're going to get caught sometimes. You're just going to wake up in the morning, look at the futures, they're going to be limit down, and there's nothing you can do about it, and you're going to get caught. And if you're on the short vol side of this thing, it's going to lead to extreme drawdowns. And of course, the problem with that, I've done many, many videos talking about the mathematical headwind of drawdowns, because if we look at this chart, as I say, losses are more costly to a fund than gains are beneficial. If you take a drawdown, say you take a 10% drawdown, it actually requires an 11% subsequent gain just to get back to the break-even point. When you're dealing with something like TVIX on the short vol side of things, well, you're not talking about 10% drawdowns. You're talking about 40, 50, perhaps 70 or 80. If you really get caught in one of those once every 5 or 10 years type of thing, you could basically spend most of your time just digging out of the drawdowns you're in. So it does seem on the surface sometimes like a good idea. People think, well, great, I've found something that goes down violently. Let's just short this. Well, in practice, it never works out that way, and they typically spend most of their time digging out of those extreme drawdowns because you will just get caught. There's just no way of getting around it. If you're trading volatility, yeah, you're going to get hit with something, and it's probably not going to be once. It's probably going to be, once, twice a year type of thing. If you're really good at this, maybe once a year, but yeah, you're going to get caught. And the problem is it just moves too violently on both sides of the trade. So if you want to see just how violently, this is a chart of the long-term beta factor. Beta is just a simple measure of how much one thing moves in relation to something else. So here we've got the rolling TVIX beta to the S&P 500. You can see this number here, long-term average, about minus 5.45. That's actually the exact long-term number. If we look at the long-term mean here, the TVIX to S&P beta is minus 5.45. So essentially, this is a 5.45 leverage factor product to the S&P. Now, of course, there's variance in there. Beta is not an exact measure. It varies quite wildly. It could be up as 8 or 10. Sometimes it's only 2 or 3 times. But long-term, it just moves too fast, and people get themselves into way too much trouble. I can't tell you how many times I get emails from people who have found themselves in a lot of trouble, and they'll email me and inevitably ask me my opinion. How are they going to save themselves? And, I get several a week. I actually did get one this morning. So this is typically what they will look like. So I'm an investor. I'm long-term stock investor, but never invested in futures, options, or volatility. That's a bad sign when you're investing in something you've never done before. But put all your life savings in UVXY thinking that it will pop. This is a very common thing that I get so many people telling me that, look, the markets are weak, the inflation's going to crush us, the Fed can't save us forever, it's going to all fall apart here. So I'm going to go ahead and buy the UVXY, or even worse, buy the TVIX if it was around. And then you end up in a massive drawdown. So what do you do? Well, of course, I'm not a registered advisor. I can't tell people what to do with their money, can't make personalized investment advice of any kind. But typically when I get these emails, and I get them, like I said, several per week, both on both sides of the trade. This one happens to be in trouble trying to time a long spike, but I get them just as often with people who tried to short the shares outright. Somebody on Twitter told them it was a good idea. Now the volatility spikes and they're in a 50% drawdown. So typically I will just tell them, what the product is, how it functions, the methodology behind it, show them charts on the decay factor and what you can expect. And hopefully they kind of put 2 and 2 together and realize that you really shouldn't be trading TVIX or UVXY on either side of the trade. It just moves too quickly. So like I said, it's one of those things where you're dealing with a beta factor that's so high. I know it looks enticing on both sides. You know that TVIX can spike up 500 or 1,000%, and you think you're going to time that volatility spike. Well, outside of just dumb luck, I would say you're probably not. You're probably going to end up just bleeding too much capital. And on the short side, of course, it looks brilliant. It looks like the easiest trade in the world. But in practice, trust me, this is a massive losing trade that could end up having you owe the bank money in your account. So either way, pretty poor. The only thing that I will say, in fairness to TVIX, is there is one application that people might consider, and that is with hedging, right? It can serve as a decent hedging tool. Now, the problem there's always problems with these things. Hedging is one of those things that people have the impression that it's something easy to do. You have a net long portfolio. Well, I'm just going to buy TVIX and hedge it, right? If my portfolio crashes, my TVIX will do really well. And there we go. I've hedged my portfolio. Unfortunately, hedging itself is extremely difficult to do. It's very detailed data science to get hedging correct. It's not something that you just make an estimate. Well, I'm long this, let's just buy a few shares of TVIX. If you get that calibration wrong when you're doing your hedging, right? If you have too much TVIX, well, then you're going to be subject to all of that insane decay. And your portfolio, even if it's doing well, your TVIX is going to be like an anchor. It's going to drag everything down. If you have, not enough, then you go into one of those crashes and the amount of TVIX you bought isn't going to hedge you as much as you thought, and you might end up in a drawdown anyway. So hedging is not easy to do. It's not one of those things that the average investor can understand. You have to go into very detailed understanding of, as I mentioned before, beta factors, how much each of your allocations in your portfolio move in relation to the S&P, and then how much the TVIX moves in relation to the S&P. You want to pair those together. You want to have certain bandwidths, like I'm okay with a 10% drawdown, but I don't want it to be 15 or 20. That calibration is extremely hard to do as well. And when you're dealing with something like TVIX, 2 times leverage, well, you get it wrong and you're in trouble. So even if it's being used responsibly as just a hedge and not speculation, it is still something that not many people should be looking at. You can still hedge your portfolio with VXX. And if you're wrong, it might be less punishing for you. So just grand scheme of things, that's why I say there really aren't that many really responsible uses for something like this one on the right for TVIX. Now, I understand why this group is trying to get it launched, because it was a very successful product when it was around. Assets under management was very high. Whoever does get one launched again is definitely going to have an opportunity to make some money. But for me personally, it just doesn't really fit into even sophisticated investors' portfolios, but certainly not in the average investor's portfolio on either side of that trade. So I've done many, many videos. I'll just show you a few of those as well. Just remind you that you can use this search function. I've done, I don't know how many videos I've done, but there's a lot. You can just type in TVIX right here, and you can get some pretty good warnings from me. This one about it being delisted. Don't buy TVIX. That's pretty direct. A lot of reasons why people shouldn't do it. A lot of stuff. TVIX, 2.8 billion to $200. You can learn all you need to know about this disastrous product called TVIX on my YouTube channel. And I'll do plenty more in the future, especially if this thing launches. But now let's move on to what is far more interesting, certainly to me, and very likely to many of you out there. And that is on the left side of this thing, the old XIV or the new SVIX. Like I said, I did a video on the SVIX over a year ago. You can watch that. It's on the YouTube channel. But for me personally, whether I use it or not, I don't yet know. I think I could probably find some uses for it within a few of my strategies. But if you're like me, most traders, we do like to be our own risk managers. We don't like banks and regulators telling us what we can and can't do with our money. So even if I don't use it in all of my strategies or even many of them, I still do want it to launch, because more options on the market, the better it is for us. I do wish that this would just kind of disappear, because it's too much of a dangling carrot in front of inexperienced traders. But as far as the XIV goes, yes, it's very risky. Yes, it can terminate in a single day. you have to know what you're doing if you're going to be trading them. But like I said, for me, I'd like to be my own risk manager. I want to look at the landscape and choose the products that match what I'm trying to do. So I sure hope that this launches. The reason that it probably took a year and it's still not active yet, it's been approved, but it's still not active. So let's slow down a little bit. The reason for that, I'm sure many of you know this, but here's a little, trip down memory lane. This is the XIV live trading since November 29th, 2010. That was when it launched. And it was eventually delisted on February 14th, 2018. This is the big Volpocalypse event that we all talk about. Volmageddon, Volnado, whatever you want to call it. February 5th, 2018, this XIV crashed 96% in a single day and was terminated. So it was doing pretty well, as you can see. It was an exciting product. I started trading it very early on. I actually have a video showing my earliest trades in both VXX and XIV all the way back to 2010. So I've been doing this a very long time, and I loved this product. It's very risky. It suffered very large drawdowns along the way, but if you have certain systems to manage some of that risk along the way, try to see some of those red flags developing, and definitely consider cash as an active portfolio position. Default to cash anytime that there's any ambiguity. This is actually a really good product. And I've made a lot of money trading the XIV over the years. So I do miss it, and I do hope it launches. But it's not difficult to see why a regulator might have a tough time approving something like this, because long-term annualized return of minus 7%, obviously not great, but a maximum drawdown of 99%. This might be something that they want to protect investors against themselves. Like I said, I'd like to be the person that decides that for myself, but not difficult to understand. But the XIV, as we get into why I suspect this group might actually be able to get this approved, it's important to know that this product does not trade based on supply and demand. So it didn't crash on this day on February 5th because a whole bunch of people sold their position on XIV on the same day. It does not behave at all like a regular stock. These things track underlying indexes. They all have an underlying index. As far as the XIV, maybe I'll even leave a link to this, but you can see underlying index for the XIV, a 1 times inverse. It looks like this. And this is exactly what the XIV looks like, right? Decent in the last year, 3-year return, not so great. 5-year, we can now see the Volpocalypse event, but it is a underlying index, not a supply and demand product. The XIV is just tracking the changing values of these front 2-month VIX futures, a combination of both of them in what we call the VX30, the constant maturity VIX future contract, as they approach the VIX index at expiration. So really, we can look at a chart, even though the XIV is terminated, we can still see what it looks like after the termination. This is the underlying index that the SPX or the XIV is based on, SPVX SPIT index. And we can see again, it didn't really correct itself after the Volpocalypse spike. Annualized return down almost 8.5% over 8.5%, 99% drawdown. So, and of course, I should point out a lot of drawdowns along the way. You can't see 2011, but it drew down 67% in 2011, European debt crisis, drew down 76% in 2015, over 80% in the COVID crash. So this thing obviously has had some problems. But a lot of people look at this and they think, well, aside from that one terrible day, it's actually a pretty good product. Maybe we could even buy and hold this thing on the long side. If you're one of those that are thinking that, I would say slow down a little bit. This is that underlying index starting on February 6th, 2018. So this is the day after Volpocalypse. Doesn't include that 1-day kill shot. This is what it would have looked like had the XIV just continued normally. Again, not great, right? It's down 7% per year, 87% drawdown. This is not something that anybody could even consider on a buy and hold basis, right? And again, it's kind of like the TVIX, works the same way on both sides. Can't do it on the long side, can't do it on the short side. It just has drawdowns that are too large and movements that are too quick. So you do need a system to move in and out of. But here's we get to the interesting part, because I'm sure some of you watching this are thinking, well, how could a regulator even consider approving a product like this? It's clearly terrible. Well, the reason is because the XIV, even though it did crash 96% in a single day, that didn't happen because of market activity. It didn't crash 96% because the volatility in the market itself caused that. What I mean by that is there was, of course, a big volatility spike. It was the largest in all the history of the VIX, going back to 1990. There's February 5th, 115% in a single day. However, it actually didn't happen during regular market hours. Now, it was still down that day. It was down a lot. Volatility sort of built up into this crescendo of insanity. The market started normal that day. It wasn't one of those gap down days where it was going to be ugly from the start. The market looked fairly normal that Monday, and then it just built up to a crazy amount. But this didn't happen during market hours. The XIV itself was down roughly 35% during market hours. And then at 4 o'clock, the markets are technically closed, but futures and options and a bunch of other things are still trading. And this product has a methodology that it has to rebalance its futures after the market is closed, the aftermarket rebalancing. There's a 15-minute window there, and that's when it happened. It went down 35%. So it was struggling the week before February 5th, and then it would have dropped down about 35% during market hours. And then the aftermarket rebalancing, when all of these volatility ETPs go out into the market and they have to rebalance their product to keep their exposure, and that happens on both sides of the trade, long and short, anything leveraged products, they have to rebalance as well. They have to buy the futures to rebalance to gain that long exposure. You can understand that there was a lot of competition, and it was essentially a liquidity crunch. So it wasn't because of the 115% VIX spike. It was actually because when these products go out and rebalance, the volatility market at that time, that was right at the peak of the, the golden era of short volatility trades, where all of those products together were an insane amount of assets under management, well over $5 billion at the point. And it basically overwhelmed the VIX futures market. So that's what actually happened. And I would imagine that is going to be front and center of all the presentations and all the filings that this group is doing to the regulators, because really you could make a case that the XIV crashed and terminated not because of the market activity, but because of a flawed methodology. Of course, they didn't know when it was launched in 2010 that the size of the volatility ETP market would grow to such an extent that, 9 years later it would cause this huge aftermarket rebalancing issue. But now, looking back in perfect hindsight, we can see how flawed that rebalancing process is. And so if they just tweak that, maybe widen the window so they're rebalancing in a much more amount of time, not in direct competition with all the things, with all the other ETPs, using weighted averages. There's all kinds of things that they can do to improve on that methodology. And they might actually be able to get to something that, while this might not look incredibly impressive, this is what it would look like if the XIV, like I said here, using end of day before rebalance estimate on February 5th. So this is using the crash of about 35%, not the aftermarket rebalancing. This is potentially what it could have looked like had they been able to save it through a much better methodology, where there isn't that liquidity crunch in the aftermarket. And there are ways that they could maybe do that. Maybe not all the way, but certainly make huge leaps forward in trying to reduce just the overall stress of the volatility ETPs on those VIX futures. And so, again, it's not great. I'm not suggesting that this would have been just fine and everything's, it's not risky anymore. It is still very risky. But remember, we went from about a minus 8.5% annualized return up to 21.5%. Obviously, you can't buy and hold this thing. That sounds good. Wow, I want 21.5%. You can't buy and hold it because the drawdowns are just insane. Like I said, a 67 over here, 76, 80 during COVID. Can't do it. But this is actually the Feb 5th event if we use the rebalance period and just eliminate that. So I would imagine, like I said, this is what they're going to be focusing on. If they have any chance to get something that terminated after a single day kill shot launched, it's going to be focusing on the aftermarket rebalancing period. And I suspect that's why it was approved, because it does make some sense that the product wouldn't have terminated had it had a better methodology. So, I don't want to give people the impression that everything is completely fine if that happens. It's still a very dangerous product. Volatility products themselves, you really do need to know what you're doing. If anything that I said today about how they track a 30-day constant maturity VIX future, if any of that is news to you, probably shouldn't be trading them until you learn a little bit more about that. Watch some of my videos, read blogs from other people. I'm obviously not the only person that is educating about these things. You really want to know what you're doing before trading these products. Because, again, even if you fix the aftermarket rebalancing issue, let's not pretend that terrible things even worse than February 5th couldn't happen. What you're looking at here, first of all, when we look at the largest VIX spike in history, as we call it, on February 5th, 2018, conveniently, the VIX only goes back to 1990. Because if we do just drag it back a few years, we can use the old VXO calculation when it was just using the S&P 100. And October 1987, it doesn't matter what methodology the XIV was using, it would have been terminated. So, it spiked up. This is a close to close, 312. But we're talking about an intraday spike of 375% in a single day on the old VIX. It would have terminated even the best XIV methodology product. So, again, I don't want to give people the impression that if this product launches, if it passes regulation and actually goes, that all of a sudden, green light, do whatever you want. No, they're still vol ETPs. And of course, TVIX, or the UVIX, as I think it's going to be called, insanely risky product on both the long and the short side. You can lose a ton of money on either one of those. There is no smart money when dealing with TVIX. It just isn't. The long people, they don't know what they're getting themselves into. It's going to decay a lot faster than they think it is. The people who think they're the smart money because they're the shorters, well, you're going to get whipsawed as well, and you're going to spend most of your time digging out of drawdowns. So let's ignore that one. If we go back to our landscape here, I guess the last question people might be asking is, what am I going to do when they launch? Am I going to use these things? Like I said, I hope I've made it abundantly clear that just with my personality, my risk tolerance, the way that I manage my portfolio, this new UVIX has no place anywhere in mine. But the SVIX, it actually does. Our tactical volatility strategy very likely will just continue using VXX options. I think there's a lot of benefits to just sticking with the VXX options. Risk mitigation being first and center. It's much safer to be trading those VXX options. So that strategy will probably stick to it. But we have several others. The aggressive vol strategy, for example, it currently uses SVXY. And there have been times, it's been going for over 9 years, but there's been times when I used recently 2 times SVXY to try to simulate that old leverage factor of the old XIV or the old SVXY. Because remember, before February 5th, the SVXY was basically materially identical to the XIV. It was also a -1 times leverage. They deleveraged it afterwards. Instead of terminating, they just deleveraged it. But I could see myself potentially using the SVIX in our aggressive vol strategy. Maybe not for sure. I'll have to wait and see. I'll run all the numbers. But yes, I'm definitely looking forward to it launching. I think the more options we traders have, the better. Hopefully everybody's educated enough to know what they should and shouldn't be trading. So I'm hoping it launches. I wish them all the best of luck. Seems like it's taken a major leap forward recently. We've been waiting a very long time. Over a year with really no news and updates, but we did recently finally get one. So exciting stuff, I would say. If you've been in this volatility space for a while, you'll know that it wasn't that long ago, maybe 3-4 years ago, where we had over 24 volatility ETPs, and there was choice everywhere. Obviously, that creates a lot of problems for people who don't know what they're trading. The email that I showed you, or the 1,000 others just like it that I could show you, are evidence of that a lot of people get themselves into significant trouble doing this. But more options, the better. So hopefully we do get that full spectrum. I'd throw this new SVIX and UVIX in the garbage if we could just get a new ZIV. So hopefully somebody out there, some group, maybe this group, maybe a different one, will get on that. I think the thing that is a real headwind to ever see a ZIV product again, which is sad for me to say, but the volume was never very good to begin with. So it's not one of those things where a bank or a group of people are going to want to really aggressively push for, whereas the TVIX had huge assets under management. No doubt the new SVIX, if it launches, will have no trouble at all ramping up to a pretty significant level. That old ZIV is just, it breaks my heart, but we probably won't ever see another one like that. It is what it is, but those are the new products. So just to make you aware of them, like I said, when they launch, if they launch, it's not a when yet. If they launch, I'll do a better presentation, something that I can edit, and so I don't forget a bunch of stuff. I'll do another live stream, but always good to be aware of what's on the market for you to trade, and obviously the risks. So like I said earlier, I can't give out any personalized investment advice, but hopefully my rather strong warnings against just haphazardly jumping into this volatility space, hopefully people get the point that there's nothing wrong with paper trading for 6 months, seeing if you can develop a reasonable strategy before actually jumping in with real capital. Hopefully that's what people do. Obviously, I can't tell you that's what you have to do, should do, but wouldn't be a bad idea. Lots of ways to trade volatility. ETPs, long and short, options are endless, futures, everything. Choose the right product that matches your risk tolerance, know your product, understand exactly how it works, and you should be okay. The short vol trade is awesome. I know sometimes people watch my streams and watch my videos and they think I'm a little bit too negative, but look, if you know all the risks ahead of time and you can still go into the market and make money, then you're just better prepared, and you're going to have a long-term success in this space, this volatility space. You could have a 30-year successful trading career in the volatility and option space. But if you jump in not knowing what you're doing, you could find yourself 6 months from now further behind than you were, and you're just going to waste a golden opportunity. So I am negative. I am always strongly warning against people doing this on their own, uneducated on it. But that doesn't mean that I don't think everybody should make an effort to have some percentage of their portfolio allocated to the short vol trade. Hasn't been working well recently, and by recent we basically mean, I can even show you that if you want, the last 3 years. This here, how far does this? Yeah, that's 3. And this is a rolling daily rebalanced short VXX position. So the standard benchmark short vol trade since January 1st, 2018. So this is the last 3 years and 2 months of just the straight up short vol trade. Well, it's down over 40% per year, a 91.6% drawdown. Trying to turn this into something profitable, hopefully people realize that's going to take a level of education and a level of experience that 6 months to a year of paper trading might actually be able to at least get you pretty far on that process. But you can't just jump into this market and expect to turn this absolute disaster of a short vol trade in the last 3 years and turn this into something profitable. It just doesn't work that way. If the S&P 500 is down 10%, 20% every year, it'd be pretty unlikely that you're going to go in there and make 30% on it. It just doesn't work that way. So yeah, know your products. We got potentially 2 coming. I will keep everybody updated on what's going on with this thing. Exciting stuff. So hoping for XIV replacement, SVIX. Don't care at all about UVX, TVIX. It can die a slow death. Don't care. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.